Alright, so we just got the single biggest economic indicator that a recession is pretty much inevitable at this point. This has been the only economic indicator that I've been able to find that has 100% consistently proven to be true, and here's what it is. Jim Cramer just told us he may be the only person who doesn't believe a recession will happen, besides maybe Jerome Powell. No! It's gonna be even worse than we thought. It's official. We need no bigger proof than the Cramer signal. Just kidding. No one knows exactly when a recession will happen, other than maybe the exotic dancers, which are starting to say the exotic dance clubs are starting to become empty, because it's either gas money or dance money. And I know where my priorities are. In all seriousness, the recession is inevitable. It's gonna happen at some point, but no one knows when it's gonna happen. Could be this year, could be next year, could be 2024, no one knows. For now though, things aren't looking good and inflation is heating up, with gas prices, for example, in some parts of California reaching almost $10 a gallon. It's kind of insane. And this problem of inflation isn't just happening in the US, it's a worldwide problem. Bank of Canada, for example, recently said they were trying to bring down their inflation, and now it looks like they're at a risk of a recession. The UK is now seeing the highest levels of inflation in the last 3 decades. Europe just reached a record high of inflation. Even Japan, which has had historically low, in fact negative inflation for decades, is now seeing inflation. And that's the new problem that we're facing, which is inflation in the face of layoffs, which have started to get worse. Elon Musk, for example, says he's starting to get worried about the economy and wants to cut 10% of Tesla's jobs. Now, just for context, Tesla employs roughly 100,000 people around the world. So a 10% cutback means roughly 10,000 people would lose their jobs. And all of these layoffs are not just happening in the world of stocks. Crypto is having its own recession and their own layoffs. Coinbase, for example, says they are retracting new job offers and they're implementing a new hiring freeze. Gemini has already cut 10% of its workforce, and you know that things are getting really bad when the 6th largest commercial bank in the world, JP Morgan's Jamie Dimon, is warning everyone to brace themselves for an economic hurricane. So there's plenty of people around the world telling us about this recession. So in today's video, I want to explore some of these concepts and show you how these layoffs will potentially impact the market based on some new historic data that I found, which could hopefully help us out. So let's get into it. Hi, my name is Andrei Jikh. Hope you're doing well. Come for the finance and stay for the recession. All right, I'll stop. So first, I just want to say I'm not here to convince you that a recession will or will not happen. I'm not interested in selling you on any specific idea because I don't know what's gonna happen. Instead, I just want to break down the complexity of the market so that if you're investing, we can hopefully use this information together to make a better decision based on what we know. So first, let's talk about inflation, because if there's one thing our government didn't know, it's about how bad inflation could get, which is why they've recently admitted to being wrong about the seriousness of inflation. Now here's the thing, there's 3 separate entities that are dealing with and preparing for a recession in their own separate way, and that's the government, our corporations, and ourselves. Now, we all want the same exact thing. We all want to prevent a recession and fix inflation, but we all have a different way of playing this game of economics. So here's how our government is playing it right now. Behind you. Now, personally, I imagine the government to be more like a mage type character. It's a lot of sorcery, hard to understand, but this mage has 2 main spells to help us avoid a recession and fix inflation, and that is monetary and fiscal policy. Now, I'm not going to assume that you remember anything from the days of college economics, so let me break it down. Monetary policy is stuff our pup pal, the central bank, aka the Federal Reserve, does to influence the amount of money and credit that's in the system, which at this point is in excess of $3.3 trillion of liquidity and almost $9 trillion worth of assets. Now, a lot of things with monetary policy have to do with trying to influence the interest rate, which, if you remember, we talked about this QT, quantitative tightening process, which just started this month on June 1st. Now, this is when we will start slowly selling $45 billion a month worth of assets, $30 billion toward treasury bonds and $15 billion toward those mortgage-backed securities or MBSs. And after 3 months of selling at this rate, starting in September, we're going to double to $95 billion a month, $60 billion in treasury bonds and $35 billion in those MBSs. Now, this effect of selling will increase the interest rate, aka the federal fund rate, by anywhere between 0.25% to 1.25%. This is as close as economists can guess. They don't know specifically, but that's the range. Just remember that it's the federal fund rate that sets the benchmark for all the other interest rates, including prime rates, which affects everything from home loans, auto loans, student loans, and everything in between. So that's how you drain the liquidity. You raise the rates, you incentivize commercial banks to stake their money or park it with you to earn the high rate, but hopefully discourage them from borrowing with those high rates, which should hopefully discourage them from borrowing and spending and increasing inflation. So that's the strategy. Just remember that monetary policy has less to do with politics and more to do with the Illuminati. No, more to do with central bank stuff. So that's the first tool. Now, the second tool that our mage has at its disposal is something called fiscal policy. And this is a little more political because it involves Congress and the president trying to pass a bill. If you remember the 2020 stimulus package, that was a great example of fiscal policy. Right now, President Joe Biden is trying to lower inflation by reducing the federal budget deficit. This is the amount that our country spends in relation to how much it makes. Now, I'm not going to go way into the details of that, but there is some critique because people say the two are not always directly related. The point is, our mage here believes that the recession will not happen, but another character in our story does. And that character is corporate America and its trusty sidekick, Wall Street. And you can think of this character as sort of like a physical type character that sort of slashes you. Maybe looks like Wolverine right here, which I recently learned also looks like two Batman kissing each other. You will never unsee that. Think about it, it's the perfect analogy. One character, two Batmans, Wall Street, corporate America, working together hand in hand. Anyway, the point is, this character works in a very selfish way in the sense that it protects itself against a possible recession by cutting costs. And that's one of the biggest worries in the economy right now, which of course are layoffs. In the month of May, for example, there were 15,000 layoffs in the tech space alone. And here are just some examples of that. Peloton has laid off 2,800 people. Carvana is laying off 12% of its employees, which is roughly 2,500 people, citing that the car industry is already in a recession. And here's how you know that this is true. This picture, that's a Porsche Cayenne delivering Domino's pizzas. I don't know, when I think of someone driving a $70,000 car, I don't imagine that they are delivering pizzas as a side hustle for some extra cash. Maybe that's not a stable market because they loaned money to everyone. Half kidding, no idea if this is actually real or not, but the truth behind the scenes is that the repo market is heating up, and there's already warning signs. So once those repoed cars start to hit the market, thanks to the people that got loans from the stimulus days that can't make payments on them anymore, banks will start to tighten their lending requirements. And with interest rates already up very high, and because of the QT, there's less liquidity, banks have less money that's not insured by Papa Powell, they're gonna be less likely to give out those loans. So once the supply goes up, demand will go down and prices will go down. Cars will not keep appreciating at this crazy pace forever. My friend Lucky from Automotive Life has a really good video about this on his YouTube channel, which I will leave a link for down below. Robinhood is cutting 9% of its workforce, and Coinbase, which so far this year has lost over 70% of its value, I know, because I'm a shareholder, they've said they cut back on hiring into the foreseeable future. But the most interesting thing I saw out there was what Microsoft said. Because despite amazing earnings so far this year, they've revised their Q4 estimates downward. And the reason they gave for that is because of unfavorable foreign exchange rates. And this got me really interested. I was like, what do they mean? Well, I don't know. Let me look into it. And what they're referring to is the value of the US dollar specifically. And this is gonna blow your mind because believe it or not, corporations actually benefit more from a weaker dollar, not a stronger one. This is because when companies do business overseas, they get paid in that country's foreign currency. But when they go to convert it back to US dollars, they're gonna get less dollars for their profits, which makes them less profitable. It also means that US products become a lot more expensive, therefore other companies buy less of our stuff. And this is especially true for Microsoft, which gets half of its profits overseas. And right now, our dollar is very strong, and it's going to get stronger later this year, which is what Microsoft is predicting. Kind of interesting that it's so counterintuitive when you first think think about it. So remember, a weaker dollar is a bad thing for us as consumers, but at an investor level, it's actually a really good thing. So anyway, moving on, Netflix has already laid off 150 people, and Wayfair, which is a company I've used for a lot of my furniture, has implemented a 90-day hiring freeze. And the list goes on and on. In fact, there are over 30 companies in the month of May alone that have started to cut back. Now, some people might look at all this data and say, that's just the tech space, Andrei. That's an isolated problem. You don't have to worry about people with inflated salaries. That doesn't represent the average middle class income. But that's not 100% true, because it was those same people with their tech jobs and their high incomes that influenced a lot of the local market values. So the worry is that if those tech jobs and their incomes disappear, then those same asset values could also be negatively affected, specifically in states with no state income taxes. If you combine that with the worry that these layoffs could potentially spill over into other industries and things could go south really fast. Now, I also looked into venture capital or VC funding, and that is slowly starting to slow down as well. So all around, when investors look at this data and they see how many hiring freezes and layoffs and how these companies are putting out all these bad news, it affects people. It scares them, they sell their investments, and the market goes down. So the market is behaving predictably defensive. But let's not forget there's a third character in this story. Let me share with you some new old market data that will hopefully help us out. So once again, the last character in our story are the muggles. That's us, trying to live our best lives. We don't have special powers other than two little tricks, hope and voting. And voting has a 4-year cooldown period, and then we have to recharge. It's kind of annoying. But here's some good hope news, because between the years 1926 and 2022, the stock market averaged 9.95% per year. The total stock market return, or cumulative return, was over 885,000%. And even though there were certain periods of time when the stock market went down like crazy, if you look at the market as a whole, with 20-year rolling periods, the stock market has always made money. In fact, the cumulative returns 5 years after the market dropped 20% or more on average was 69.9%, which goes to show you that if you can stay in the market for the long term, history is on our side. Now, if we do get pain though, here's what we can expect based on historical averages, because over the last 96 years, the stock market went down 15 times when it lost 20% or more. That's the bear market. And on average, the stock market lost 34.8%. So that's what we can expect. The amount of time it took for people to reach the bottom of the market was 264 trading days. The amount of time it took to recover from that bottom was exactly 567 trading days. The only exception to this was the Great Depression, which from September 3rd, 1929 took 3 years to reach the market bottom, June 1932. At which point stocks lost 84% of their value. It then took until 1945 to fully recover from the losses. So someone who started investing in 1929 didn't break even until 1945, 16 years later. That's why they called it the Great Depression. But in the end, it always worked out with those 20-year rolling periods. On the bright side though, last week, US jobless claims went down by 11,000 down to 200,000, which means we have one of the strongest labor markets in decades. In fact, in March of this year, we hit a 54-year low in jobless claims, which is awesome. So I hope that these hiring freezes and layoffs are contained to tech, but the truth we have to face is that that will still probably affect the economy. So for now, I'm gonna continue working, continue saving, investing, and losing money in the market. But that's okay, because history is on our side. As always, have a wonderful rest of your day. Smash the like button, subscribe if you haven't already. Go grab up to $250 worth of free Bitcoin right here. Go grab your free stocks. All the links are down below, and then go track them automatically with the spreadsheet link down below in my Patreon. Love you. Thank you so much for watching. I'll see you back here on Monday and Friday, sometimes Wednesday. I'd love to know your thoughts. Bye-bye.